So what we're going to do in the papers is it's due Friday. However, I'll make the official date March 27th because I want, guess what I want from y'all? Mediocrity or greatness? What do y'all think? I want to be running up to Dr. Wall's office and go, you can't believe an undergraduate student wrote this. And I mean it in a good way, not in a bad way. You can't believe someone wrote a paper this great. That's what I'm looking for. So I'm going to show you a student paper. I want y'all to take out a piece of paper and write the sections down so you can make sure you have those. If you want to turn in your paper this Friday, I'll get it graded, get it back to you. I have an exam to grade this weekend, so I probably wouldn't have gotten graded anyway. But if a third of class turns them in, I can probably get them graded. But I'll give you an extra week because I do want greatness. I really want y'all to do well. So here's a paper. So the abstract's okay. You don't have to do that. You do want, especially if you're going to put this out, this is a great paper to put out on LinkedIn. If you're going to put it on LinkedIn, you do want something that says, in this paper, I am going to. You want the first thing people read is what's the paper all about. It can be, I mean, you can see this paper provides, it doesn't have to be, some Hemingway novel or something. It can be. I was asked to do an assessment of this bank's risk management process. I selected, it can be that kind of just bare bones. This is what I'm doing. So if it's on LinkedIn, they see it. I like this approach. I prefer to have the this section centered, but you can do it either way. I do like the italicized, but essentially it just says, hey, I wrote this paper. This is why I wrote it. You can put a little extra stuff in there. I was specifically asked to focus in on market risk, but I will go, however you want to do it. All right. So that's start off with any paper. What am I doing here? Your professor might give you an article to read. Say, hey, in this paper, I'm going to summarize the article assigned in class, blah, 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 by so-and-so. Have it so the person sees it. They know why you have this paper down. The second thing you're going to see is which bank you chose with some quick overview on the bank. Don't just jump in and say JP Morgan's risk management process, blah, blah, blah. JP Morgan, who are they? Biggest bank in the world, biggest bank in the US. What is it? How much? $3 trillion in assets, some gee whiz numbers, probably one paragraph. You don't have to do it a massive amount, but here, just a quick intro. All right. It always makes sense. In my investment class, I'm teaching that again this fall. Their last two papers, none of y'all have had that class. Their last two papers is a stock valuation, and there's students that will do that won't tell me anything about the company they're valuing. They'll just jump right into the valuation. It's like, no, you always want to say, hey, I'm doing a valuation of Netflix, online streaming company. Always start off with who is the company. So very first thing, what are you doing? Second thing is an overview of the firm you're writing about. Then you get into, now they added this is optional. They decided to give some context, say, hey, JP Morgan had a big risk blow up, so this is obviously important to them. If you want to do something like that, but that's not required, but that could be in there. Then they go over the intro. So an overview of the firms. They could have had a little bit better definition, but over the risk management process, they kind of have that here. So what's the paper about? An overview of the bank you're writing about, and then their risk management process and philosophy, or philosophy and process, a section on that. All right. So that's the third major section. What would be here? Something about their philosophy. You can find some quotes from the annual report or from their website about what risk is important to them. I like comments like, I went to their website, the word risk doesn't come up until their core values. It's not in their mission statement, things like that. So you can say, how important is this? Process is really, really important. Process has three things. It has the people, and has the process itself, and it usually has the committees, which is kind of the people. So who's involved? Always the CEO, always the board, always the chief risk officer, and who's the fourth one that's always involved? Internal audit. Those are, every bank's going to have those four groups in there. Internal audits should be independent and go directly to the board. Shouldn't be reporting to the CFO. It should be directly to the board. So those are always there. All of your banks going to have that. Your bank may not have a chief risk officer. I can't imagine there's any one of your banks doesn't have a chief risk officer. That has become the thing. One thing you might ask is it as a figurehead or is it actual someone with power? One of the first things I did when I just met the CIO of USAA just a couple weeks ago, I looked at his background. Yeah, he's from Harvard, so that stands out. He kind of joked about that, but I mean, he said, how can you tell someone went to Harvard? Because they're going to tell you about it pretty quick. That should be true for UTSA as well. But I'm not a big fan of Harvard because it's cases. I don't like cases. I don't learn with cases. I don't like cases. I prefer to create my own case and not do some artificial one. But Harvard is a case studies. That's just the way they do it.
Are you expecting us to find out like who the actual people are?
You could, it's not required, but do they have a chief risk officer? But that's what I was saying is I might actually look that person up more out of curiosity, not for the paper. Are they a Harvard grad? Do they have a finance degree? Do they have an actuarial degree? They may have an engineering degree, or a lot of these chief risk officers are more stats than they are finance. That's not required, but I would be interested in that. I mean, you're looking at your career, what kind of people are you going to look at? So a lot of students, they'll look at the job they want now and look at the requirements, but that's not what you want to do. You want to look at the job you want in 5 years and see what they're doing. What degrees do they have? What certifications do they have? If you want to be the chief risk officer of JP Morgan, which is probably a 7-digit salary, I would guess, maybe 8 digits. What is their background? That to me is just curiosity that would be interesting. Are they getting a finance degree? Are they getting management science? Are they getting engineering? What is their background? I don't know, but that would be really interesting to me. They didn't do that in here. And then internal audit, you do want to just make sure to mention it's kind of obvious, but that they directly report to the board. They have an independence.
Would it be would it be all right if we like cross-reference what our bank's doing with what other banks are doing?
Well, if you have that extra time, it's up to you. You have a small handful of banks because once you get down to a certain level, they're not quite as comprehensive as here. But I'm not asking you to do that. Sometimes I think what's more interesting is over time, the same bank. That would be tough to do, but they added the CRE function in 2009 after the 2008 crisis or something like that would be interesting, but that'd be tough to find. You could go back to 2007 and see if they had a chief risk officer, right? All that stuff's out on the internet, but I'm not saying to do that, but it would be interesting. I think about internal audit. Who is internal audit? What degrees do they have? Accounting. Are accountants good at risk management? Not generally. They're not taught. Internal audit at JP Morgan, probably pretty good. But that's because they're specific to this bank. So they probably are pretty good, but internal audit from Walmart could not show up at JP Morgan and do the job. But it'd be interesting to see, who is the chief auditor at JP Morgan? Are they an accountant? Are they finance? What is their background? The auditors at USA were pretty good, but we were doing some stuff they did not really understand. I'll talk about some of the stuff. I kind of scared them a little bit because they were focused on stuff. And I go, yeah, that's interesting. You realize we could destroy this entire operation over here. So you might want to be looking over here at what we're doing. So sometimes they do miss. My guess is that your banks, the internal audit is so deep into banking that they're probably pretty decent at it, but they are accountants. They're not finance people. Then you have the committees. So what's the paper about? Who is this bank? Their philosophy and process. The process is who are the people, the committees, and then the actual process itself. You probably will have a chart of some kind. I've seen them that shows the different committees. I think some of them are really confusing, and you can certainly comment on that. I look at 3 committees, and it's like, how does this committee know where their line stops and the other starts? So remember at USA, we had what we called the Corporate Asset Liability Management Committee, the COM committee. The CEO sat on that. We met quarterly. That committee did everything. There were subsidiary committees in the bank, the life and life insurance, property and casualty, but everything reported up the CEO. The CEO said, "This is where I'm going to learn about risk at USAA. You other guys can do what your job is. You can report up." But he sat on that committee, and he was there every single meeting. If he couldn't make it, we rescheduled it so that he could make it. He took it extremely seriously, and those meetings would last 3, 4, 5 hours. He went through everything in detail. That's not how these banks do it. They have all these multiple committees. To me, I find it a little bit confusing, but you might want to look at a few of them. You have the operating committee, the firm-wide risk committee, the ALCO committee. Almost all banks have an ALCO committee called ALCO. Is it obvious what one does versus the others? Do they report to different people? Bob Davis was really interesting at USA. He did not believe in committees, so he picked a person. So if something went wrong, he didn't go to the committee, he went to that person. And that's just the way he operated, which worked really well for my career, because I got that. It could have been disaster, but I got that person in a few places, and you're like, you better know your stuff, because he's not going to go complain to committee. He's going to have you fired if something goes wrong. But think about it. So go a little bit deeper in here. I'm not asking you to spend hours and hours and hours, but think through it. When you see these committees, you don't need to spend a page on every single committee, but do think about them overall. What is this process? Does it sound like a good process? Here they talk about the process here. Essentially, that's the define, measure, mitigate, but what is their process called? How do they break it up? My part of mitigating is the monitoring and reporting. That's part of the mitigation, is the monitoring report, but they probably have as a separate place. Risk identification is, to me, the definition, define, measurement, and then everything else here is mitigation, but they call it different things. So that's part of the process. I have seen banks talk about this 3-line of defense. You kind of already talked about this. You have the lines of business, you have the corporate, you have the board of directors, you have the internal audit, you have these different lines. But think about it, look at that process, find a way to summarize that. If, I love Notebook LM, you might take that section of the bank's risk management, save it as a PDF, give it the Notebook LM, and ask it to summarize it for you, and see if they can give you an interesting way. We use Notebook LM for our podcast, and this week it went crazy. It was ridiculous. I mentioned that gold prices had fallen, which was unusual in a crisis, and their reason, I didn't give them a reason. I just said they decided to come up with a reason. Their reason was so ridiculous. So you can't always trust Notebook LM. I wish I could go back and put the reason in. Why did gold go down last week? They were saying there was some liquidity crunch or something like that. Gold went down because the dollar strengthened last week. Why did dollar strengthen last week? Well, because, it's inflation is it's a global thing, but it's a relative thing. So the US dollar did better than other currencies. Gold is much more sensitive to the dollar than it is to other things. I wish I put that in there. They didn't find that answer. They come up with this whole solution that was so ridiculous. And then they went on for like 5 minutes about it. So I had to cut that whole section out. My podcast went from 20 minutes down to about 12 minutes because they just went so crazy. But what I love about Notebook LM and ChatGPT, and have y'all tried Claude yet? Is Claude pretty expensive or is it pretty cheap?
The same.
Similar. DeepSeek. Gemini, really, Notebook LM, I think, is probably part of that. So yeah, you can certainly do that. You can't have them write your paper for you, but you can certainly get ideas on, what's critical here. What do they do? It'd be interesting. I'm interested. I'm really amazed at how well AI does in summarizing some things. There's a few of our podcasts where they brought up things where I thought, well, that's kind of interesting. I better go check and see if it's actually true, but it's an interesting perspective. So it might throw you off on a tangent that gives you something really, really valuable to put in there. But that can help you. If it's like, there's so much verbiage here, can I let AI summarize it for me so I can hear it in someone else's opinion, but then do the work, make sure it's correct and accurate. I know some of your classes don't allow you to use AI, but you got to use AI. I've talked to over 100 alums this last year. 100% of them use AI, not 98.3%, 100, they're all using AI. So you got to use AI. So use it, but use it wisely. Don't copy and paste. So they talk about those lines of defense. Then they get into essentially definition. This is kind of part of the process. This is maybe a little overkill, but essentially what they did is they said, what are the risks that they manage? And they give us a short paragraph on each one. That's a little much, but that wouldn't be bad to say, hey, here's our universal risks. These are our categories with a quick definition. That would not be bad to do. They went a little bit more in depth. So liquidity, reputation, credit, market, which is the one we're focusing in on, operational. So country and climate risk management. I don't know what climate means, if they're talking about the actual climate. Yeah, they are talking about actual global warming, but it could just be the economic environment. All right, and then they get the market risks. All right, so what do we have so far? You start with what? What am I doing? Second thing. Who is this bank? Third thing. Philosophy and process. Under philosophy, give the philosophy, and under process, what are you definitely going to see? Four groups, right? And then talk about the process, talk about the committees. You might get their universal risk. I'm not saying that's required, but that usually is pretty valuable to say JP Morgan breaks their risk universe into the following risk with a quick definition. Maybe not this overkill with such a long paragraph, but that certainly gives a good insight into the bank. USA's risk universe was over 100 the last time I saw it. Ridiculous, way too long of a list, and some of the items didn't make sense to me. I think JP Morgan's list makes sense. You've seen my list in the class that we're using: interest rate risk, liquidity risk, market risk, operational risk. There's quite a bit of overlap between the definition we're using. And part of that's because I'm stealing my definition from the group of 30, which is, a major global kind of bank reg group. So it makes sense you would see that. All right, then you get the market risk. You need to have titles. First of all, it makes your paper easier to read. Secondly, it makes sure you don't leave something out. So market risk, you have three things. What three things will you have? Define, measure, mitigate. All right, you'll have those three sections. The definition needs to be the bank's definition, not my definition or your definition. Don't tell me what you think market risk is. What does and they'll have it. Every single one of these banks will tell you what market risk. They may call it price risk, but they're probably going to call it market risk. What's the definition? You'll probably have a quote. You may even, I like having quotes like this, where you italicize it. That just makes it look really professional. So if you have a long quote that goes on more than 2 lines, I would separate it, italicize it. You don't even have to have the quote marks. Just separate it. You can say from page 17 of the annual report, they define market risk as, and then the critical thinking is you could add after that definition what I think they mean here, or what they're saying here, or my summary of this. You can put it into your own words. That's a critical thinking kind of thing. Sometimes it's so obvious that there's just not much to say about it. You could say, this definition speaks for itself. Really, no more elaborations needed, but there's their definition. He did, under definition, do essentially what he did in the previous section, is say, what are those subcomponents of a market risk? And most of your banks will have that. In fact, I think all of them will have that. This is a pretty common list. Interest rate risk, we already talked about that. We'll talk about foreign exchange risk, equity risk, commodity risk. We won't talk about those separately, but that's under the market risk. We will talk about credit risk. Here they're talking credit spread risk. We're going to talk about when does credit risk go under credit and when does credit risk go under market risk. And some banks do it differently. So we're going to talk about, you don't have to do that in this paper. When we talk about credit risk, some people define credit risk only as default risk, that someone has missed a payment. Some people talk about credit risk as both default risk and price risk, which is the bond price fell because they got downgraded and the spread went up. So here he's showing credit spread risk, which is the price risk part of credit, not the default. Default goes under credit, but it depends on the bank. They do it differently. So there's our definition. He shows the value risk chart. You definitely want to have that value risk chart in there. Really, really important chart. All of your banks have a chart and probably a graph. Really, really important stuff. I would try to find their risk tolerance. It's probably going to be 5 or 10%. Then you get the measurement. It has the word measurement. What will you have in there? Definitely value at risk, definitely stress testing. Those two will always be there. You might have value at risk back testing. You might have earnings at risk. There's other ones that they use. To me, earnings at risk, those type of numbers is really just another stress test. So some of them kind of overlap, but value at risk is one you'll all have. VAR back testing is becoming more common. Stress testing is always going to be there. To me, stress testing and sensitivity analysis are the same thing. Don't feel like you gotta distinguish them. So stress testing just means you're running a scenario, right? Interest rates rise 300 basis points. What happens to our net worth? What happens to the value of our assets? What happens to our net income? Those are stress tests. So if you like to, you could say stress tests. JP Morgan has what they call stress tests, blah, 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 blah. They do other stress test things, which they call scenario analysis, and you could have those listed, and they'll usually just put that in there. And then mitigation, you'll all have diversification, right? 100%. What else would you have? Derivatives, you'll all have derivatives. All these banks do something with futures and options and forwards and swaps. You may or may not have risk limits, but if you have a value at risk, does the bank also say, hey, we have our value at risk can't be more than 50 million. So the value at risk would be the measurement. Saying can't be more than 50 million would be the mitigation. Just look for it. You might do a search on your annual report on the word limits or risk limits. Back when I was doing this, the risk budgets was the term, but that one's kind of going out of favor, and banks almost all use risk limits now. You can notice here with JP Morgan, he doesn't have the limits. All he says is there's committees that set these limits. That's good enough. So you just say that they do it. That gets it. And then monitoring is one that's kind of obvious to do. Don't go too overkill here because you hit it pretty well probably in an introduction side. You already have the committees. So it might be. Now, he did something you might do. He broke interest rate risk as a separate area of market risk as a subcomponent. You could do that, or you just make it part of it. So you have to kind of decide. Look, if your bank has a separate section for interest rate risks, it might make sense. You don't have to go quite as extreme here. I might just define market risk and then say market risk includes the subcategory interest rate risk, which they define as, and then anything that's specific interest rate would just be in my measurement and my mitigation. I wouldn't do it separately. He decided to do it separately, but you could certainly do that. Here he has a stress test on that. So that earnings at risk is a stress test, right? So when you see things like that, that is just an example of a stress test. Plus and minus 100, 200 basis points, those are stress tests. The fact that they call it something else, I think it's somewhat frustrating. They say we have stress tests, but we also do earnings at risk. It's like, yeah, that's just an example, another example. So they make it confusing. Economic value sensitivity, what is that? That's a stress test. It's another one, just with another term. Scenario and stress testing, what is that? That's stress testing again. All right, so a little bit, he did his best given the fact that JP Morgan was somewhat repetitive. Who writes the annual report? It's the same people, the audit committee, right? It's the accountants. At USAA, the accountants wrote the USA's annual report. So, I mean, I was responsible for my section for the wording of it, but the accountants put it together. Now, Ricardo Rosales spoke to my security analysis class a couple weeks ago. What his firm does is they go out and look at these annual reports and other reports on companies, and their focus is on what word changed. Because you gotta know 95% of this is probably boilerplate from last year, and they just update the numbers. But what if they changed a word from concern to serious or something, you know, one word change? Why did they do that? So if an accountant changes a word, you know, you're kind of working. We do that with the Federal Reserve, right? We're going to do this next Wednesday when the Federal Reserve releases its minutes. We're going to look at how much they're talking about the terrible employment situation, how much they're talking about oil prices and inflation. We used to parse that down. What word did Greenspan use this last time? Oh, he used some. Well, the previous time he said few. Oh, what's the difference between some and few? Because do you think Greenspan made a point to change that word? Absolutely. Really clear. Now, Greenspan was different than Powell. Greenspan was intentionally ambiguous. Then Bernanke came in and said intentionally unambiguous. But that makes it even more important because that means Bernanke, when he changes a word. So I'm not telling you to do that, but that would be interesting to me to see, hey, what actually changed between this one and the last one? That would be a lot of work to do, but that would be pretty interesting. Is it possible to PDF the entire section and ask Chat GPT, hey, what are the major changes in this section? Could it do it? Or is that too much to ask? That'd be pretty interesting, right? So he has liquidity risk. Don't do liquidity risk. If you're going to cover it, it's in that introduction section just for the definition. I don't know why they went that wild. In fact, if I see liquidity in your paper, I'll probably be worried that you took some previous student's paper and edited it and didn't realize. So he has a long section on that. I wouldn't do that. All right, so you got the introduction, what you're doing, who is this bank, their philosophy, the process with the four groups, and the committees. Then you're going to do in the market risk, define it, measurement. You got the obvious things there, mitigation, the obvious things there. Then you have your conclusion. Your conclusion is the toughest part because you're supposed to give me your opinion on a process where you're probably like, and it sounds good to me. Who am I gonna? That's why I don't like case studies at Harvard. It's like to me, it seems a little arrogant that someone who just started college is going to sit down with Blockbuster and tell the CEO of Blockbuster, here's what you should have. I read the case, took me 3 hours last night, but here's everything Blockbuster should have done. That seems a bit extreme to me. So use your framework, use their framework, think through it. Think like the CEO. If you became the CEO of JP Morgan, is this a process you'd walk into and think, man, I feel pretty good, or here's the places I'm most concerned. These are parts I understood the least. These are parts that seem redundant to me. I really wonder if this chief risk officer has the power to do these kind of things. Those kind of questions that come up, which means while you're writing your paper, start jotting down those questions. Wow, I really wonder if. And then the hardest part of this section is do you think this bank is too big or too complex to manage? Can Jamie Dimon, why did they have this well risk happen at JP Morgan if they're so well controlled? Why did Goldman Sachs have one MBD or whatever it is, the Malaysia thing? Why did that happen if they're such good risk managers? Why did Wells Fargo blow up on all these accounts, which isn't part of what you're writing, right? Wells Fargo's big problem wasn't market risk, it was operational. But if their process is so good, why did this blow up? So that's why it's kind of good to start with, hey, they had this big blow up a few years ago. Obviously, they're not perfect, but let's look at their process. Do you think the well risk changed how they do their process? Possibly, probably so. So are they, and do you really know? Are you far enough along that you can tell JP Morgan how to run their business? Give me your opinion. That's the critical thinking part. You can put some humility in there, obviously, as undergraduate college student. Who am I to tell JP Morgan what to do? But just reading through it, these are the areas which I found most confusing and seemed like something could get through the cracks here. It's not bad. Especially if you're gonna put this on LinkedIn and then go interview at JP Morgan. You don't want to be just bad mouthing them. Right. So y'all got all the sections there. So make sure that's all there. Have a title for each one of those. Some sections, it's so obvious on the measurement. Those things should be in there. It's so obvious in the mitigation. Those things should be in there. Make sure y'all have them. Measurement, value at risk, maybe back testing, stress testing. Stress testing can be several different things. Then you get in mitigation, obviously diversification, obviously you're gonna have some kind of risk limits. You know, those are obvious things every bank has. And if you can't find it, all of your banks have value at risk. So don't turn in a paper that doesn't have value at risk. Now, if you go to Frost, or if you go to Broadway Bank, they may not have value at risk. But I was on the board of a credit union at USAA, and we actually were starting to calculate those kind of things. And this was 20 years ago. So yeah, we got the poor accountant there. She was like, you want me to do what? I was like, yeah, kind of interesting. Do you think it's more complicated than what they're showing here? Yeah, these are very complex organizations. But I mean, it's kind of amazing, right, that this is in that annual report. You probably had no idea banks put all this information in there, and you can see they're somewhat competing with each other, and they probably have influencing each other what's included. I imagine if I'm an accountant at JP Morgan, I'm looking at what Citibank is doing, that they added a new section, a new chart. I'm probably looking at that. Is that something we want to add? It's a lot of information. You might say, why would they tell us all of this? Well, they want the stockholders to understand, we got risk down, we understand risk, extremely important. You know, you're trying to sell this to the stockholders. So very, very, very important. All right, any questions on this? Some students ask me how long the paper should be, and the answer for that is long enough. All right, never ask your boss how, it's like, yeah, I want to make sure I don't work too hard on this. How many pages do you want? Yeah, whatever is necessary is what is necessary. Do what is needed. Definitely don't give me double space. I hate double space papers. You don't want a double space paper on LinkedIn. It just looks horrible. I know students do that because it's more pages, but it's hard. If you send me a double space Word document, guess what I do? I go and make it single space because I don't like double space at all. It just looks so terrible. If you do double two columns, make sure to keep the margins really thin. It's tough to put some of these graphs in here, but these are readable and they fit in the columns. And that's another reason, keep the columns really, really thin. I mean, the margins really, really thin so you can fit these things in here. Some of them are pretty massive, but they do fit pretty well. Don't have a chart in your paper that you don't discuss somewhere. Usually right after it or right before it in the following chart, blah, 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 that kind of thing. So yeah, don't put something, nothing worse than if your boss a paper, you got a chart and now your boss is reading through the whole paper to try to figure out where you talk about the chart. Say, well, it's an interesting chart and you never talk about it. And it's like, you just threw it in there. That's not good. So make your comment as close to the chart as you can. All right, everybody's good? Would y'all be okay if that was your paper and put it on LinkedIn? That's something you would be okay with, a paper like that, or that look like a mediocre paper or look like a strong paper? Pretty strong, right? Pretty thorough, maybe too thorough. But certainly they're covering the material. All right. So the paper officially due next Friday, the 27th, but if you want to turn it in this Friday, I'll put it out there on LinkedIn. All right, so we were talking about correlation and standard deviation. Last class for this idea of risk and correlation, how stable are they over time? And standard deviation assumes a normal distribution. And we talk about with a normal distribution, you should never see an 8 sigma event. It should just never, never happen. Maybe once in every 6 trillion years. And in the 80s, we saw 3 of them around the 87 crash. In the 2000s, really in 2008, we saw several in 2020. I'll show you some of these numbers. I'll go through the numbers. I don't know if I have the file loaded, but if not, I'll show you on Tuesday or on Thursday. So we have these outland. Most other decades, yeah, they just don't have any at all. But in 2008, we had 5 of them all in the last few months. So the first part of the year, even with the Bear Stearns collapse, we didn't have any major days there. JP Morgan came in, bought them out, kind of quietly took over that firm. Have y'all even heard of Bear Stearns? Is that still a name y'all have heard of? I know the CIO of USA mentioned Solomon. He was at Solomon. Y'all may not have heard of Solomon, but these were big firms. 2008, Bear Stearns went under, then Lehman Brothers went under. So two of the four big guys went under. But 2008, it was when Lehman went under. That's when we started seeing these crazy events. Here's correlation. You can see how unstable, especially between stocks and bonds. We talked about that. So the last couple of weeks, stocks have been selling off and bonds have been selling off. And when does that happen? You remember? And you're worried about inflation. So treasuries didn't help you this last week. In fact, treasuries have sold off pretty dramatically. They fell below 4% at the end of February, and now they're jumped back up to like 4.3% pretty rapidly. So they have very high positive correlation. In our dashboard team on Monday, we talked about how over the long term, stocks and oil prices aren't that really correlated to each other. They're kind of independent. There's a little bit of correlation. They care about each other. But in March, the correlation is negative 0.73. Why? Because that's what everybody's focusing is oil prices. Today, stocks did well, even with oil prices up a little bit. So today somewhat bucked that trend. But obviously right now, everybody's focused on the Strait of Hormuz. So there are these events that can take, hey, these things are normally uncorrelated or unrelated, and suddenly they become highly related because of that specific event. How do you manage risk when your measurements of risk are high, low, high, low, high, low? What assumption do you use? It makes it pretty tough. And here's what happened in 2009. Everything was down pretty dramatically. We'll talk about bonds. I'm going to have a video I want y'all to watch. We'll probably watch it in class because it's not very long. We'll talk about how finance really lies when it comes to bonds, because when you say bonds, you got to be careful. Are you talking about treasuries or are you talking about corporates? Because in 2008, treasuries were up 20%, corporates were down 20%. They're not the same asset class. And the guy who did this presentation conveniently used treasuries to show how good bonds protected the portfolio, but most investors don't buy treasuries, they buy corporate bonds. So it makes a big difference that you can be real careful. Here is a bond. High yield was down dramatically. A typical 70-30 portfolio was down 31%. How well did diversification do you on the stock side? Didn't really help you at all, right? Pretty pathetic. Here recently, we've seen growth stocks and tech stocks somewhat sell off, and value stocks have come back. That's not true last couple of weeks, but you saw value stocks really helping you the last few weeks. But we're talking about the market being down 3-4%. When the market's down 30-40%, everything's crashing. So it doesn't really help you. And here's large company, small company, developed markets, growth side, value side, both down 44%, emerging markets down 48%. Just no protection whatsoever. High yield was actually down more than this, but that particular index. On high yield, you got to really ask, what's the average quality? Is it double B, single B, triple C? It makes a big difference. What we saw in 2008 is some investment grade bonds were dropping 20, 30, 40%. And some high yield actually came out okay. So it's kind of strange. We saw some bizarre behavior. What are you going to do well, first of all, do you think this will ever happen again? Was 2008 a once in a billion year event, or will it happen in your lifetime? If it's going to happen in your lifetime, how are you going to manage this risk? You just say, hey, it's going to happen. We'll just all lose money and we'll get by. Or is there anything you can do in advance? That's what we're going to have to talk about. Are there things you can do to protect yourself? What's missing from this list? What was up in 2008? I believe catastrophe bonds were. I love catastrophe bonds. Treasuries were up. This isn't treasury. Gold. I'd have to look back at gold. I can't remember if gold did that well.
Gold went down.
Yeah, I can't remember 2000. I'd have to look back up. It's possible. I know in 2022, gold went down even with all that inflation because the dollar strengthened and real yields went up. That's the other thing why gold went down last week, because real yield, I mean, they're all related. Y'all know the whole relationship, right? This is probably a good thing there are relationships that we think a lot about. So what influences gold? So you're in an interview. So we think inflation, right? And that's a positive relationship. If inflation's rising, you would think gold would go up, right? It's a real asset. It should be holding value. You got the US dollar. There's a negative relationship there. If the US dollar strengthens, gold goes down. That's what happened in 2022. US dollar strengthened, gold prices fell, even with all that inflation. Highly related to US dollar is not interest rates, it is real interest rates. Even more important, what are real interest rates? It's nominal rates minus inflation. You'll know nominal versus real, right? Nominal is the actual interest rates that reported. The real rate is what TIPS inflation index do. They're a negative relationship. In 2022, the real interest rate went from like negative 1% to positive 1.5%. That was horrible for gold. So those are the primary ones. So what happened last week? We had inflation scare with oil prices, but the dollar strengthened because real interest rates jumped up about 14 bips. In fact, nominal rates went up about 13 bips, real rates went up 14 bips. So all of the interest rate rises last week were real rates. It wasn't the inflation adjustment, it was real rates coming up. The stock market is another one. There's usually a negative relationship with that, though 2025, stock market was up, gold prices were up. So there was a positive relationship last year. 2022, stock market was down, gold prices were down. So not always. And then you just have supply and demand. So it's kind of funny. The guy who ran USA's precious metal fund worked for me. The guy was 10 times smarter than I was, but he worked for me. It's kind of embarrassing. I had to do his performance review, which was like, good job, Mark. Just keep it up. He was the #1 mutual fund in the United States, not bond fund. I mean, not precious metals fund. He was the #1 mutual fund out of every single mutual fund in the United States. He was #1 for 10 years. So how do I do his performance appraisal? Yeah, good job. Yeah. Here's your bonus. So supply and demand, you have to look at that. There are certain countries that are extremely important, like South Africa, Ghana, India. India is very sophisticated in how they buy gold. They tend to hold a lot more in gold as an asset than we in the US do. South Africa and Ghana are big producers of gold. So if there's a strike going on in South Africa, you're going to have to kind of, how's that going to influence it? Obviously, right now, what's going on is big governments like China are buying a lot of gold and holding on to it. That's kind of influence. So when Mark would come to me and say, I got to talk about gold and my write-up for the fund, he's going to ask, what do y'all think inflation is going to do? What do you think about the US dollar? He's going through this list. He doesn't ask me about supply and demand. I don't know that, but he asked me, what do y'all think about the stock market? Is it rich? Is it cheap? The stock market's going to sell off. Gold's probably going to do well. So those are the things you want to talk about. These two right here are so closely related to each other. If real rates rise, what's the dollar going to do? It's going to strengthen. Is it possible, and you could go back and look, is it possible for real rates to fall and the dollar to strengthen? It would be really unusual. So these two are really closely related. But there's also an influence of inflation on these other two. So in your money banking class, y'all probably talked about this quite a bit. I mean, these are the relationships that they're not all perfect. So we saw in 2022, inflation jumped. You would expect the US dollar to be weak and real rates to kind of probably stay the same. But the US dollar hates inflation, but loves high real rates. Gold loves inflation, hates high real rates. So there's different scenarios, and it's going to be important here. These relationships are not constant over time. So it gives these surprises. And then this last, we've seen a couple years where these are not there. So that's the general approach. But when we look at these asset classes and say what's missing, you have to ask, would that have really saved you? So in 2008, if you had commodities, would that have helped you? Oil and those type of precious metals, oil, agriculture, would that have saved you? So catastrophe bonds did well. Why did catastrophe bonds do well? Because there was no hurricanes, earthquakes in 2008. They're floating rate securities, and they did really well. They had no credit risks, so they did well. They did great. But there's other years they're not going to do well. So, you have to look at it. The key is to figure out what asset classes need to be on your list so you can think about all of those and think about how they're going to perform. I remember at USA, I think I talked about this. They had an inflation fund. Yeah, I did talk about this. Had inflation fund. They put REITs in there. And it's like, man, that inflation takes off, interest rates going to shoot up, REITs are going to shoot down because they're bond substitutes. You got to think through those scenarios. So the real key here is scenario analysis, just like your banks are doing. What if inflation goes up, but real rates also rise, like in 2022? What does that mean? How will this work? So go through this. And how do you do scenario analysis? A lot of times history is not a bad approach. What happened in the 70s when we had high inflation? What happened in the 90s when interest rates were falling and inflation was coming down? Get these different scenarios and think through what that means. If you're specifically looking at gold, pretty critical. We're going to talk more about the scenario side. Another way of saying this is the environment. So we'll get into that when we look at alternatives, but 2008 to 2009, and it's just September through February. It's not even an entire year. Not much was working for you. If you'd had 30-year treasuries, you would have been in great shape. You probably would have been up 30–40%. How many people had their entire portfolio in 30-year treasuries? Probably almost nobody. Probably the guy in Austin, good old Lacey Hunt, he probably did, but not many people outside of that. Here's the thought process on efficient frontier. Here's the risk and return of the individual assets. So this right here is 100% emerging markets, which is the outermost point on the efficient frontier, but it doesn't do really well because you're 100% emerging markets. You can't get any riskier than 100% emerging markets, so it's the outside point, but it's not on the efficient frontier. So you can look at the combination of portfolios of assets. This is also small cap all by itself, which used to do really well, but you can see by combining asset classes, there's always a combination that has a higher return at the same level of risk, with the exception of small cap and emerging markets, just because they're the furthest out there. So it makes some sense, but the problem is to build this efficient frontier, you need assumptions for return, risk, and correlation, and then those assumptions are hard to get because they keep changing so much. So the conclusion, does diversification still make sense? In my opinion, for individual stocks, yeah, you probably should have at least 20 stocks in your portfolio, just in case some major news comes out. It works. Data shows significant drop in risk with minimum impact on your expected return. Obviously, I would have loved to have Apple as my only stock the last 20 years. If you can go in a time machine and go back and invest, do that. I would have probably put $1 million into Bitcoin several years ago. I could buy Bitcoin at $2 a coin. That probably would have been a good investment, but would I have done that? Would I have been smart enough to do that? I know I'm not smart enough to do that. So diversification does make some sense because we're not perfect predictors of the future. Even if you're really confident a stock's going to do well, you never know what might take it out with the AI world. Familiarity and benefits of concentrated portfolios maybe is not as important today because of our access to information at our fingertips pretty quick. Caveats: the unsystematic risk, that company-specific risk that disappears with diversification, that part of the analysis actually falls in a crisis, and the systematic piece becomes more. So the benefits of diversification, they're there, but they're much lower in a crisis, which is the time you want them to be higher. So that's one caveat. Betas themselves are unstable. So if you're using beta to say, hey, this firm has a beta 1.5, they're really sensitive. This one has 1.5. The problem is betas themselves are pretty unstable. So even that approach. And betas, When they're really high, that may actually be a good time to buy the stock because they're probably going to revert to the mean. And if their beta is really high, people are probably using a high discount rate and they're probably undervaluing the stock. I was going to actually test that thesis and see. I just didn't have time to set it up. But it may set up a buy high, sell low phenomenon. So I don't know. How many people use historical betas? People use historical betas. If you have stock whose beta is unusually high the last 5 years, that may be a good time to buy that stock just because if everybody's using that beta, they're using a high discount rate, they're going to undervalue it. But that would be a good proposition hypothesis to test, wouldn't it? To see if that actually gives you a good analysis. And stocks that have unusually low betas probably want to be avoided because there's a good chance they're being overvalued, but I can't prove that. So for individual stocks, yeah, I think diversification makes sense. I would not recommend you put all your money in one stock, but there are caveats. For asset classes, I'm not so sure. The benefits of diversification are definitely going down because the world is becoming much more interconnected. So from that standpoint, small cap stocks even have here that they dominate, but they haven't dominated the last 5 years. Last 5 years, it's been large cap growth stocks that have been dominating. But over the long term, small cap have been the place to be, especially small cap value. They were just materially outperformed all the others. International stocks have been horrible the last 20 years. But then last year and this year, well, they were outperforming this year. They've now kind of come back. But last year they outperformed. But half of that was the dollar weakening last year. So, half of it was the market's doing well, half it was the dollar. But the problem with the asset class is the assumptions are so unstable. Correlation and standard deviations are so unstable by asset class that it's hard to come up with an assumption. Now, when you do project 2, I will be giving you the assumptions. You're somewhat stuck with my assumptions. And they are assumptions that I think are perfectly reasonable. They're probably pretty similar to what other firms are using. But it's one assumption for correlation, one assumption for standard deviation for each of these asset classes that we know is pretty unreliable. So, and then the other problem is these extremely rare events occur much more frequently than they should. So what we're telling our client is the risk. That's true as long as 2008, 2020, 73, 74, 1987, as long as those never happen again, you're in good shape. I mean, try that with your client. All that bad stuff that happen, we got you covered. We're assuming that never happens again. So just letting you know, we're taking care of your risk. We put in our model the assumption that will never happen again. How does your client going to feel about that? Doesn't sound like a very good process, right? Like the CEO of UTSA used to say, hope is not a strategy. Hope is hope. So will this happen again in your lifetime? And if you think it will, how is that going to change how you manage risk going forward? It might just be, hey, that's life. Those things are going to happen. It's going to be painful. I can't do much about it in advance, or maybe there are things you can do. And I do think there are, in some circumstances, there are things you can do. So rather than kicking out everything you've learned in undergraduate and saying there's no hope, let's look at some alternatives. Okay, so I'm going to leave you on the alert. So the first one is environments. So I'm going to show you two groups, Bridgewater and HCWE. HCWE, I didn't know anything about them, but they did a lunch presentation at the CFA Society. I got their presentation, put it out there on Canvas for you. Very, very similar. I think I put the Bridgewater article out there on Canvas. So most of you can be working for a firm if you do investment strategy side where you're helping your clients manage money. If you're a wealth manager, you're going to be in that efficient frontier world using standard deviation and correlation, all those kind of things. And let's look at what they say. This is pretty radical. We have a different view about correlations. We believe that correlation does not actually exist. Okay, that's kind of crazy. There's correlation, you can calculate it, but what do they say doesn't exist as an inherent characteristic of an asset class? Asset classes don't have correlations as far as their inherent. They have correlation you can calculate, but that's not part of the asset class. It's just happenstance of what happened historically. Correlation is a statistical artifact, so it's all history reflecting how things happen to turn out, which provides little, and this is the key, that historical provides little or no insight into future relationships or how you should structure a portfolio. That's a pretty radical view. Have y'all heard of Bridgewater? Probably a firm you want to work for and don't want to work for, right? They have a reputation for being very high paid and also being very backstabbing, and everybody's trying to get each other's jobs. Sounds like a kind of awful place. But if you're going to jump into the fire, you can certainly do that. So what is Bridgewater saying? Well, they said asset classes don't have correlations. Instead, what they do is they have environments. They break up in the 3 environments. HCWE essentially breaks it up in 2 environments, but a lot of overlap. So Bridgewater says there's growth environments. When growth is the key. What is growth? You have a strong economy or you have a recession. How do stocks do in a strong economy? Going to do great. How do bonds do in a strong economy? Probably not going to do very well, right? Because interest rates are rising. All right. So in a growth environment, stocks and bonds have negative correlation. What about in a risk environment? U.S. attacks Iran. U.S. attacks Iraq. We attack all the I countries, I guess. So, what happens if China attacks Taiwan? Is the market going to react? Yeah. How do stocks do when a global political event happens? They sell off. How do treasury bonds do? I'm going to stick here with treasury bonds. How do they do? Probably going to do really, really well. So there you have growth and risk, stocks and bonds, clearly negatively correlated, especially treasuries. We got to make a distinction again between treasuries and corporates. So I'm going to stick with treasuries. Then you have an inflation environment. How do stocks and bonds do when inflation takes off? They both crash. When inflation falls, they both do well. So stocks and bonds did horribly in the 70s. They did wonderfully in the 80s. In the 80s and even into the 90s, if you weren't making money, you were doing something, you could walk outside and trip and make $1 million. It was just like, it was so easy to make money in the 80s. Interest rates were falling. The economy was coming back. Everything was just great. In the 70s, I came out of high school in the 70s, and you Americans, you're stupid. You should be more like Japan. They're smart, hardworking. America is done for, the U.S. economy. We're at the end of our lives. We were all depressed coming out of high school. And then it all turned around in the 80s, and then Japan fell, 90%. So these things switch around. But the 70s were just terrible. You just could not make money in the 70s. We had stagflation, high unemployment, high inflation because of the energy crisis. Sounds kind of familiar, doesn't it? But then it all turned around, and people who were completely out of the market suddenly said, wow, I wish I had jumped in the 80s. Who caused all of that? Was it Reagan? Was it the Federal Reserve? You can read the Federal Reserve's chairman, Volcker. He has a book out. The first half of it is really, really good. Pretty interesting book. The last half, he's kind of talking about his charity work at the end of his life. So it's like, I wasn't all that interested. But yeah, Volcker came in and did what? Caused 2 recessions in 2 years. But what did they do? Brought inflation down, brought interest rates down. Did Reagan do some of it? The deregulation under Carter and Reagan probably had some impact on that, no question. You had Thatcher over in Brit and the UK. Yeah, you could probably give credit to Carter, Reagan, Thatcher, but most people think Volcker, we had to get inflation under control. So yeah, inflation was driving markets for 20 years there, and that's all we were thinking about. And then suddenly we had 20 years where all we're thinking about is growth and risk. These wonderful economies in the 90s, but then we had the 2008 crisis, the 2000 crisis. So it was all about growth and risk. There wasn't a lot of discussion about inflation in the 90s and the 2000s, where it was all about growth and risk. So what Bridgewater is saying, don't diversify using correlation, diversify these environments. You need something that does well in a growth economy. Well, that's stocks. You need something that does well in a recession. Okay, that's treasuries. You need something that does well when risk is low, no one's worried about risk. Well, that's stocks. You need something that does well when risk blows up. Well, that's treasuries. What are we left with? Inflation. If you use constant correlations, you're exposing yourself to an inflationary environment and your portfolio is going to blow up. What does well under inflation? Commodities, energy. Now we talk about gold. I want to do an analysis. I just haven't gotten around to it. I'm beginning to think that oil might be the better hedge for inflation than gold, because what has caused our last two major inflationary environments? How did oil do in 2022? Dramatically well, right? Gold was down. How did oil do in the 80s and the 70s? Dramatically well. So is oil maybe a better hedge for inflation than, who knows? Because we're at peak oil, right? We were talking about peak oil in the 80s. That meant we're running out of oil. Now we're talking about peak oil now. That means we're going to stop using oil. Either way you define it, but maybe, but how much are you going to put your portfolio into oil? You're going to do 20, 30%? Probably not. It'd be a little scary, right? So inflation, y'all seeing how inflation is the tough one. It's a really tough one. Most people are diversified for growth and risk. Most people are not diversified for inflation. So it's a tough one. And you're going to find that's going to be true for your career as well. So what can you assume? Just assume inflation will never be a risk again and just assume it away. Or you got to think about what are you going to do for your client to help with inflation, right? All right, HC, yeah, if you need to leave. She told me in advance you need to leave, which I really, really appreciate. So HCWE, I don't know who they are, is this rather old gentleman, probably my age. You could tell he was coming to the end of his career. And I get the impression this guy was thinking, I got this great idea. I want the world to know about it. Before I retire, I'm going to go around and just tell everybody about it. So I said, okay, that's pretty cool. He has it down to two environments, but highly overlapping with Bridgewater. He has it down with currency and risk. So is the currency weakening or strengthening? He ties that to gold prices, which works pretty well. Gold is actually more correlated to currencies than it is to inflation. You can go back and actually test that. And then the second one is growth versus risk, which is essentially the exact same thing as Bridgewater. So growing or recession, growing risk, lessening risk. Here, he uses bond spreads. And he made the point in his presentation, that's all you need is gold prices and bond spreads. And his argument was gold prices and bond spreads do an amazing job of predicting the change in the environment. Gold prices move ahead of currencies changing. Bond spreads move ahead of recessions or growth periods. So if you see bond spreads gapping out, there's probably going to be a recession coming. Bonds do a good job. If you see bond spreads narrowing, it's probably going to be a strong economy. So that was his main argument. He said with just two pieces of data, you have a great predictor. I wish I could see his update of his analysis since then, see how well it would have done. He did have gold correct. Gold did do badly and did somewhat predict the US dollar strengthening. So how did the gold people know the dollar is going to strengthen? Because that's what they're focused on more than anybody else. They get really good at that. I don't know about bond spreads. Bond spreads are incredibly narrow right now. The bond market's essentially telling us nothing to worry about. I think there's stuff to worry about, but maybe they're right. Maybe, if the bond spreads are correct, this is the time to be taking risks because bond spreads are really, really narrow right now. He has 4 asset classes: US bonds, US stocks, gold, and he talks about real assets, including real estate. Those are his 4 categories. So this is how he lines it up. Oh, this is his. So he says a growing risk with stronger currencies. He says domestic bonds. I absolutely think he's talking about treasuries there. So risk is increasing and the currency is strengthening. That's essentially where we are right now. That's essentially where we're right now. The treasuries aren't doing that well. You have risk is falling and the currency is strengthening. That's when you go on the stocks. You have risk is growing and the currency is weakening. That's where you want to be in gold. You have risk is falling and the currency is weakening. That's where you want to be in physical assets like commodities and real estate. And he showed it over time. What was scary about his presentation is how high his gold allocation was. I would never go. He was like 40% in gold. I would never go that high in gold. The guy who ran USA's fund, he was like never go more than 10%. And that was in his mutual fund. Never put more than 10% in because it's so risky. And this guy was saying 40%. So you can see this is very different in correlation. What he's saying is make sure you have something in each one of these quadrants. But he was even going further. He was saying the quadrant you should be in is all dependent on gold prices and bond spreads. When bond spreads are narrowing, come down here. When bond spreads are wide, you're down here. That's the anxiety part, right? Bond spreads narrowing, that means anxiety is falling. Bond spreads gapping out. And then currency or gold prices. Gold prices going up, currency's weakening, you're over here. Gold prices falling, you're over here. You got your quadrants. And again, he's saying it's predictive. You just watch gold prices when they start moving up. I don't know exactly how you know when they're moving up. Exactly. So what did 2025 tell us? Higher anxiety, the currency is weakening. That's exactly what happened last year on the currency side. I don't know about the anxiety side. Certainly anxiety is higher this year, but currency is strengthening this year, or it has here recently. But it's an interesting concept. I'll come back to this next class and finish up what he had to say, but it's an interesting concept. His entire presentation is out there on Canvas if you want to look at it. All right, I'll stop there. You want to turn your papers in tomorrow, that's fine, but officially due next week. If you turn them in tomorrow, I'll probably get them graded by next Tuesday. We'll see. I have an exam in my property casualty class, but it's only 40 students, so I should be able to get it graded and get a few papers graded. So we're talking about this concept of environment versus correlation. The correlations are not stable, and they're not stable because things react differently. So what this particular gentleman did is he said, let's define every environment with just two statistics. It's really simple. What are gold prices doing, or what are credit spreads doing? Seems too simple to me, but that's what he's looking at. I might think instead of gold prices, I might look at real interest rates, which we can really do now with the tips. I just brought into our dashboard team, I brought in tip yields and the break-even inflation. You can get both of those out of Bloomberg. Somehow Bloomberg goes back to the 90s with the tips yields, which they didn't exist in the 90s. So I'm not sure what Bloomberg's doing. But with those two, he defined 4 environments, whether the currency is weakening, which is an inflationary environment, and currency is strengthening, which is a non-inflationary environment, or risk is increasing, which credit spreads be gapping out, or risk is going lower and you have growth. And so here he says, what happens if the economy is doing well? Credit spreads are coming in. Stocks do well. Bonds don't do well because interest rates usually rise in that period. Again, he's talking about treasuries. Notice there's a T right there. I'll talk about that a little bit more today when we talk about Mikhail. Gold doesn't like that. Gold likes bad news, not good news, but commodities like it. And this is probably the big issue, I think, with his, do you use gold or do you use oil to help you with inflation? One thing you can see with oil is it does like strong economies, strong environments, whereas gold doesn't. So there is a difference there. If the economy is slowing down, you don't want to be in stocks, but bonds, treasuries should do well. Gold should do well, and commodities should do badly. Then he does the other side. What if you're in an inflationary environment? Stocks and bonds, this is the real key. I think this is the key to the whole thing. Most Americans diversify their portfolio with stocks and bonds, and that means they're diversified for everything except for inflation. And you got to think through that. The nice thing about commodities, so the good thing here is both gold and commodities, because gold is a commodity, should do well. We're seeing here recently gold is not doing well. It's down a bunch with all this inflation with oil prices up. So what we're seeing right now is gold is not performing well here, whereas commodities are. So you really have to have an allocation to two. What bothered me most about his presentation was how heavy his gold allocation was. I think he had numbers like 40%. I would never put that much in a portfolio. That's just crazy. Even commodities, I don't know if I'd go much above 20, 25%. But if you're worried about inflation, should you be worried about inflation? We have these incredibly massive sovereign debt around the world. How do governments solve debt problems? They monetize them. They inflate them away. I don't know how we're going to get out of all this inflation. I mean, all this government debt without higher inflation. That's not my problem. It's your problem. I'll be somewhere in Costa Rica living off pineapples, but you guys are going to have to face that government debt, and it's not just the U.S. It's a global issue. It's the debt in Japan is even worse in the United States, and it's growing all over the world. So yeah, inflation is probably going to be a big issue. Right now, it's somewhat artificial because it's a temporary supply shock, but could be a big issue. Stocks and bonds don't like that. If you're worried about inflation long term, you're probably going to have to do something there. Now, what's missing from this chart is obviously Bitcoin and all those artificial digital coins. I've done correlations between gold and digital currencies. There's really no relationship, so you can't talk about Bitcoin being digital gold because it doesn't perform like that at all. I can't tell you anything about those because I think they're so new and right now they're just responding to hype. I don't think we really know the nature of that particular asset class yet. If inflation's coming down, stocks and bonds like in the 80s, so this is the 70s, this is the 80s, stocks and bonds love that. So if you're in a period of high inflation, which we probably will have, and you think the government's going to fix it, you're going to go into the 80s, then yeah, nothing you do is going to do badly. Even oil and other commodities did badly, but you're probably going to have a majority portfolio in stocks and bonds anyway. So essentially what he's saying is you've got these four environments and you have something that performs well, at least one thing performs well, and actually you have two things that perform well, and there's not any of these that only one thing works. And you might say here, well, oh, gold and commodities go together, but here they don't. Why? Because commodities are production asset. They like strong economies, but they're also a real asset, so they do well with inflation. So you have at least two of them do well in all environments. So what is he implying? Two things. First of all, you need to have an allocation to all four of these. Most Americans only have two of them. The second thing is you can shift your allocation based just on two inputs. What were those two inputs? See if anyone's listening to me. You only need two things, and it's pretty amazing. All right, so I'll remind you again. So you look at gold prices, are they going up or down? You look at credit spreads, are they going up or down? Credit spreads right now are incredibly narrow. I just saw a GMO article on why are credit spreads so narrow. I think I would never buy a high yield bond right now. So I almost feel like they can almost do nothing but go higher. So right now we're in a point where it's just like the bond market's like, risk, what's risk? Everything looks fine for us. It seems kind of bizarre, but that's credit spreads. But he's using credit spreads to define the growth. But then his bonds is not corporate bonds. His bonds is treasury bonds. So he's missing corporate bonds, which is a huge issue, I think, in his presentation. But his whole presentation is out there if you want to look at it. He also looked at it internationally, and it says it's essentially the same thing when you go internationally. The question is, do you look at gold prices in euros or do you look at it in dollars? How do you make your adjustment? But he says it's the same issue depending on how you calculate these numbers. All right, so it's an interesting approach. I gave you Bridgewater's, their papers out there. If you want to look at their approach, it's a little bit different. Unfortunately for their approach, it's not quite as simple as his approach. They have a model, but they don't share the model with you. They just show you that the model works pretty well, but who knows what their underlying model is. So are there other alternatives? So we talked about the environment. What about hedging with options? So this to me is the approach I like for people in their 70s and 80s, older people, because especially like in 2020, this is especially the case in 2020, interest rates were essentially zero. Putting a majority of your portfolio in the bonds just made no sense at all. You're getting paid nothing. So what I would actually recommend in 2020 would put 100% of your portfolio in the stock market and then hedge it with options. I think that's a far smarter allocation, especially after the COVID strike when stocks fell like 20 something percent. Yeah, it's a no-brainer. Put your money in the stock market 100% and hedge it. So this is how I look at it. If you have a 40% allocation to stocks, 60% to bonds, and these are expected returns, you have an expected return of 4.9%. If you instead put 100% of your portfolio in stocks, you now have a 7% expected return and a 2.1% risk budget that you can allocate to options and protect the downside. So put 100% in the S&P 500 or something else. You can buy options on almost anything. Sell call options at the money. Buy 1-year puts 10%. So you would sell the call options, maybe 25% of your portfolio to give you like a 75-25% stock portfolio, and then buy puts. Here's kind of what the strategy can look like. The blue line is 100% in the stock market. The red line is how you do if you're 40% bonds, 60% stocks. And then the green line is the hedge strategy. The thing with the green line is that's as low as you can go. So I like about this strategy, you can tell your client this is the most money you can possibly lose. What's the most you can lose with the red line? I mean, there is no limit. You can lose 100%. Conceivably, the market just keeps going down. There is a place where the hedge strategy doesn't work as well, but on the upside, it does a lot better than the bond strategy. So I'll show you some actual numbers. I don't remember when I built this. I should rebuild this strategy, this model. I'll have to go out and look at it. I built it using current option prices. Current option prices right now are a little high because the VIX has risen. So here I'll show a really, really simplified strategy. I don't like this one, but it's about as simple as you can get. All right, so we're not moving here. We're not moving. I think I've had this problem before. What is going on? Boy, anybody know what's happening here? Is Bill Gates unfreeze maybe? There we go. That helps. All right, so this is just the key with this is you've really got to sorry. You've got to look at what the pricing is. So essentially we're talking about buying insurance. This strategy works really well when insurance is cheap and doesn't work well when insurance is expensive. The nice thing is we know when insurance is cheap or expensive by looking at what? Look at the VIX. The VIX is essentially the standard deviation of the S&P 500, which historically has been between 15 and 19%. Depends on how far back you go. If you go back to the Great Depression, it can get up to 19%, but essentially around 15. So if the VIX is below 15, options are cheap. If it's between 15 and 20, they're normal. Above 20, they're expensive. Right now, they're expensive. So this strategy doesn't work really well right now, but there are times where it's gotten down to 10. If the VIX gets down to 10, you can believe I'm buying. The VIX at 10 is this, it's like you've got, there's a major fire in the forest behind your house. You don't have any homeowners insurance. So you call UTSA or State Farm and say, hey, I need homeowners insurance. So, oh yeah, we have a deal now. If your house burns down, we'll build 2 houses for you. Like, wow, that sounds pretty good. You know, there's a fire outside my house. Yeah, that's fine. We have a special going right now. That's essentially what the VIX at 10 means. Because when the VIX is at 10, insurance is really cheap and risk is really high. Because why is the VIX at 10? Because no one's worried about risk. When should you be worried about risk? When no one's worried about risk. So I love the VIX at 10. What did you notice when the VIX hit 10? What did it do soon afterwards? Shot up to 50. Here's the 2000 going into 2008. The VIX was really low. You wish you had bought some protection there, a really cheap price? So when the VIX is at 10, I don't hedge my stock portfolio. I double hedge my portfolio. We did that with the investment society once because the VIX got really, really low. So we doubled up. So the S&P fell 11% and we were up 11%. That's kind of nice, right? But the insurance was so cheap. We just said, hey, we've got a $100,000 portfolio. We're going to buy protection as if we have a $200,000 portfolio. And we ended up doubling it. So I watched the VIX. Now it's not a good time, but not too long ago was actually a pretty decent time. It was below 15, not real cheap, but it was a good time to buy insurance. And you can see right before a crisis, it's really cheap. It was cheap for quite a while in 90s, but and if you want more history, you can essentially create it because if all you got to do is get the standard deviation of the S&P 500, and if you just do the annualized 90-day standard deviation of S&P 500, and it lines up almost perfectly with the VIX, so you can recreate. The woman who created the VIX is a professor at Rice University. She was on our board at USAA, so I got to see her every quarter. I was like, this is wonderful. We didn't have any finance people on our board. We had a bunch of business people, but not finance people. And when she got on the board, she was really good on the board. She asked some of the best questions. And she sent me all of her Excel for the VIX, and I saved it on the computer at USAA, and we couldn't take anything. I should have printed the whole thing out and gone out with thousands of papers and print out because it was real. I should email her and see if I can get it again, but I doubt she would talk to me. Really astute, really smart person. But yeah, she created this a really interesting strategy, and it helps you a lot because what the VIX is, it's the implied volatility in option prices for the next 3 months. So it's just essentially telling you it's not a history. It lines up really well with the trailing 90 days, but it's really forecasting the next 90 days. And if you do the trailing on top of the VIX, they line up really well, except for when markets really shoot up. The VIX won't keep it up. But in normal times, you can almost not tell the two lines apart. So right there, you know how cheap. So in 2020, obviously the VIX shot up, but boy, this would have been a great strategy there. Especially interest rates were still pretty low there. Like, why would I put my client 60% in bonds to make 1-2% when I can do in the stock market? And if I hedge it, I would have done pretty well. But I built this one. I don't remember when I built this one. It only goes through 2023, so I should update it. But essentially what we're looking for here is for a 70-year-old person. If they bought the stock market, they would have made 11% average annual return. Their best year, 37%. Their worst year, -37%. The standard deviation of 17. Bonds would have made them 4.8. Best year, 18. Worst year, -13. Very low standard deviation. If they'd done 40% in bonds and 60% in stocks, they would have made 7.6%. Their worst year would have been -14.8. If you'd done my strategy, 100% in stocks hedged, you would have made 9.73%. Your best year, 33, but your worst year is -13.62. And I mean your absolute worst year. If the stock market fell 126, what's your worst year? 13. That's the most you can lose. The stock market can't fall 126, but if it did, that's kind of comforting to a 70-year-old, isn't it? The worst you can do is lose 13.6%. Are they happy with this strategy, or would they rather have this strategy? Would you rather make 9.73% and know the worst possible year you can have? You make 758 with no downside, but much lower standard deviation. What's wrong with standard deviation for this portfolio? What does standard deviation assume? Nice normal distribution. Does this portfolio have a normal distribution? No, because the tail is cut off on the side. So I like this strategy, not right now, but if you have grandparents, great-grandparents, boy, the VIX gets down to 10 or so, I would, especially if interest rates are not much better than 4%, Say, why waste your money on the bonds? Get into the stock market and hedge it. You might even double hedge it. If VIX gets down to 10, there's really exciting things you can do. Then it gets really, really interesting. Then you could actually even hedge this at like 120% at the same price I'm doing here. And that way, if the stock market falls, you could actually not just hedge it, even make money, which is kind of nice. But anyway, if y'all want to know how to do this, Bloomberg has a pretty good option model. I think it's OMON. And you can try different legs and different strategies and look over different periods of time. But they also use the current option prices today. So, you have to kind of watch, but watch the VIX. If you're talking to people, you see the VIX down 11, 12, and you see interest rates falling down pretty low. It's a strategy that makes a lot of sense. You can go out about a year and essentially set your client up. You might not do it every year because the VIX might get expensive. Probably what you would do is set this up for 1 year, and then after 6 months, really look to see if you can extend it or maybe unwind it. You have to be pretty active on this. You can't just let it ride, and you definitely don't want to let it ride to expiration, because if the VIX is at 25 at expiration, you now can't do anything. But if you see a change, let's say the VIX, you get in when the VIX is 12, and 6 months later the VIX is at 10, then you should unwind it and go out another 6 months and extend it out, or maybe even longer. Any questions on this? These are actual numbers, but for whatever the VIX was on the day I did this. It wasn't a particularly high or low day. It was probably pretty average, but I like this strategy. It makes a lot of sense to me. Oops. So that's an alternative strategy. I'm convinced there's some options strategies out there that are far, far, far better, and I've seen some discussions of them. I haven't had time to really, really research it much more since I've retired. We use options at USAA. I'll talk some about that. But I think there's better strategies out there. You can just type common option strategies, and all kinds of pictures will come up. You want the ones with the pictures. Cover calls I don't particularly like. It has a really bad gamma, but we did some cover calls. I can't remember what a married put is. That sounds horrible to me too. Spreads are great for individual stocks, but really not a good idea, I don't think, for markets. Protected collar, we did some of that at USAA, but the gamma is terrible. You got to really watch the gamma. A long straddle sounds really good, but it's extremely expensive. But if the VIX is really, really low, what happens to the cost of a straddle? Anybody know what a straddle is? Buy a call, buy a put. So if the VIX is really low, the straddle is going to be really cheap. So if you see the VIX at 10, straddle might be a good strategy. Most people like to do them in individual stocks, though. Strangle and straddle, essentially the same thing. These butterfly spreads and condors can be really, really interesting. There's some better ones out there. I mean, this is interesting, right? You're probably going to make a lot of money, but if you lose money, at least you cap your losses. So it's an interesting strategy. But again, here you almost want a high VIX because you want to make money on selling the options. So, you want a high VIX, but you can look at these strategies. I'm convinced there's a strategy out there for 60, 70-year-olds that's no one yet has figured out, or someone's figured out, hasn't told us. That's really, really interesting stuff. So I think options are pretty incredible things. So we use options at USAA, and it was very stressful. So I became head of equities in I think 06, 07. So Stuart retired. It was pretty funny. Stuart announced his retirement, and my department says, "Hey, Ron, why don't you take Stuart's department?" And the whole room burst into laughing because they knew I hate mutual funds. And sure enough, I had Stuart's job a few weeks later. But Bob Davis was CEO. He hated stocks, so we didn't have any stocks. And then Bob Davis left in 07 and Joe Robles started. And I tell Joe, I want to do stocks again. And this is 2008. That's pretty bad, right? But I said, I want to do it, but I want to hedge them. I want to hedge our stock portfolio. My boss was really nervous about it, but Joe Robles, I don't know if any of y'all knew Joe Robles. He passed away, unfortunately, a couple years ago. Great, 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 great man. I knew him really, really well from working with him when he was CFO, and we had a great, great, great working relationship. So maybe foolish on his part, but he trusted me. He said, yeah, Ron, that's what you want to do. Go ahead and do it. So it was, he let us do it. We didn't hedge when we started. The market went up 9%. We were up 9%. I got nervous, so we got out of stock, sold. And I said, I don't want to get back in until we have the options. So we got the options. The market sold off. The options protected us. The market essentially fell about 50%. Our portfolio lost the 9% gain and went down 9%. So instead of losing 50, we kind of went down 18, but at least we kept a lot of that. And then in November, it was time to roll the options over. And I told my boss, I don't want to roll them over. I just want to be in the market unhedged. And my boss was like scared to death. So we met with Joe. I go, Joe, and my argument was, Joe, if we don't buy stocks at this level, we shouldn't be in stocks at all. They're so cheap right now. My boss says, oh, what if we lose more? So, Joe says, hey, if you buy stocks, you'll lose money sometimes. So he was perfectly fine. I mean, this is his first year as CEO. The whole world's coming apart. And he's saying, yeah, you buy stocks. The market shot up. We went from a negative 9% return. I even showed it to you. Y'all think I'm bragging, but I'm very proud of this, even though it's your luck. You got to brag about your luck in finance. Here's USA's 2008 annual report. Before y'all were alive, were y'all alive in 08? Yeah. There's Joe Robles. So here's his letter to the members. In fact, USA's equity portfolio returned 1%. So I'm really proud of a 1% return. But he mentioned me right at the beginning, and he even put a picture of my portfolio, 1%. But the market was down 37, so we're really happy. On December 30th, we had a negative return. The market was up 1% on December 31st, so we had a 1% return. My boss was like, Ron, you better get a positive return this year. I'm like, the market's down like almost 40%, but we were like, we're all ecstatic December 31st. We put the heads back on, and then markets crashed in February. And so we were just really, 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 it's amazing how lucky we were. But any of y'all knew Joe Robles? Anybody here? He probably retired. Your parents, maybe some of your parents know him. Just incredible, a general and just incredible, incredible man. His famous saying was, I was born in the morning, but not this very morning. He didn't like people trying to fool him. And he asked really good questions. Great, great, great guy. But he let me do these transactions. I do want to tell you, I want you to be aware of what you're in for finance. So I want to tell y'all my most stressful day in finance. Y'all want to hear about that? So, because you're going to face these. So we had a put spread. What's a put spread? We bought puts and we sold puts. When the market dropped, we were pretty well covered. But at some point, if it fell too much, we start losing money again. So I had a put spread. The market was down. The puts were protecting us. I'm worried about it dropping below that next level. And so I'm sitting at my desk, I'm watching the market, and it looks like it's about to unwind. And so I call my broker dealer and say, man, this market looks like it's coming down. I want to buy back the short puts. While I'm talking to him, the market starts recovering. And never mind, we're fine. A couple minutes later, it starts coming down again. I call him again. Now, my normal option trader was Stu Rosenthal. He was at Credit Suisse. Unfortunately, he left, and he was wonderful because not only was he my trader, but he also was really smart. He could walk me through my strategies. The new guy just did nothing but trade. He didn't talk back to me. So I call him again. I go, you know what? the market's breaking down, want to buy those puts down. While I'm talking to him, the market settles down and I go, you know what? Never mind. We're fine. A third time, it starts breaking down. I call him again. This guy's making him pretty nervous, right? Can you imagine? You're this poor kid. He's just started in his new job, my trader. I go, you know what? Do it this time. Absolutely do it. He's like, are you sure? He's like, yes. He has to send me an email. I have to reply, yes, execute. So I do that, say yes, execute. In my mind, my memory is like 10 seconds later. It must be longer than that. But shortly after I sent my email, the market tanks. One of those 10% at the end of the day tanks. And I'm thinking, there's no way he got that trade in time. I don't know what my max heart rate was back then, but take that times 1.2, and that was my heart rate that time. I was a nervous wreck. He calls and he goes, Ron, that doesn't sound good, does it? I'm expecting him to say, we didn't do the trade, and man, I don't know if you still want to do it now. But instead he goes, Ron, we got that trade in like just in time. And boy, talk about, oh my word, my heart rate just like that. And it saved us hundreds of millions of bucks like in 3 minutes. It's just amazing. That particular trade, it was huge. So I was very happy. I kid you not, I got up from my desk and I laid down on the floor because my heart rate was so high. I just had to relax. The guy who worked for me, he comes in, he sees that the market's down. He's like, well, he's thinking we just lost a fortune, right? Because I'm laying on the floor. So it's like, Ron, you see the markets? I'm like, so I tell him about the trade we did. And he's really relieved. But yeah, my heart rate's like that. Those are tough days. That could have been horrible, right? I had to go to my boss. We would not have had that positive 1% return if that had happened. We would have been down quite dramatically. Those are tough decisions to make. You got to make them. You're looking at the markets. So, yeah, I mean, it's just, I wouldn't want to repeat that at all. I'm kind of, they have me working with this UTSA portfolio now. I don't like that stress. I don't know if I want that back. They didn't ask me if I wanted to do that. They just assigned it to me. But they're tough days. It worked. Joe Robles, first year as CEO, and he gets the financial crisis. And in that year, I gave him a positive stock return and a pension plan who tripled its surplus. So I said, I'm retiring. You have a good year in finance, you retire. I knew it was all luck, especially the pension plan was all luck, but you go out on top and you retire. And that was the way to do it. But yeah, I mean, these are tough days. Can y'all handle those type of days? You have to make a decision. I think part of it is that your head is in the game, that you're thinking about it, that you're actually going, kind of what I was talking about on those pension swaps with Morgan Stanley, that you're thinking about it. I need to make a decision. I think finance sometimes it's like we're not even paying attention. You got to pay attention, but then you have to make a decision, and it is really, really, really tough. So yeah, it's an amazing job, a scary job, but yeah. Let's look at the stock market itself. So this is the stock market back to 1927. It has an average daily return of essentially zero. Just like we talked about on the exam, your expected return is usually zero. The standard deviation of the S&P 500, essentially it's 1% a day. It looks a little higher because I went back to the Great Depression, but essentially the stock market has a 1-day standard deviation of 1%. So 1% is a big day. Today was almost a big day, and then the market's recovered throughout the day. So I can look at the probability of any given day by taking 1 minus Norm's dist of the absolute value of the difference from the mean divided by their standard deviation. Essentially what I'm asking is how far is 0.57% from the mean? And I take that and I take the Norm's dist, 1 minus that. What it's saying is 32% of the days are higher than a 0.57% return. 41% of the days are worse than a negative 2.3%. 20% of the days give you a return less than 0.96%. All right, let's see if we can, there's a big day. About 7% of the time, you'll get a return worse than 1.65%. 7%'s a pretty high number, right? Or I mean, that's like 19 days a year, so it's not that uncommon. See if we can find something a little bigger here. We're getting into the Great Depression, right? How often do you see a 3.5% day? Almost, it's pretty rare. Most years, in fact, most years don't have a 2% day. So you can go an entire year without a 2% day. So that's pretty rare. Here's a 3% day. So pretty rare. 3% days are pretty rare. There's a few other 3% days. So 3 is pretty common in the 20s. Then you get into the 30s. And you start seeing a few more big days in the 30s. There's a 3.7% day. There's a 6% day. How often do 6% days happen? Yeah, you don't really expect one. When's the last time we had a 6% day? Well, we'll see. What happened on Liberation Day? Do we have any 6% days then? Obviously 2008, obviously, but the 6% day is a pretty big day. There's a 4% day. That doesn't happen very often. Look at that. You had a 5% day, then a 3% day right together. It's rare to get a 5% day. But what's the chances of getting a 5% day, then a 3% day the next day? That's going to be almost impossible. There's a 12% day. How often do you get 12% days? Mathematically impossible according to the math. What about a 12% day followed by a 10% day, followed by a 12% day, followed by a 5% day, followed by a 5% day? What if you worked here? Does that look like fun? That's pretty horrendous, isn't it? That's just absolutely, that's even worse than 2008 by far. I mean, this is that's crucial. And here you say, well, at least got 12% back. But remember, if you lose 25%, you get 12% back. You didn't get half back. Your losses are much bigger than gains back because the 12% is on a much smaller number. So you started at 26, you fell down to 20, and it came back to 22. This is the S&P 500 that today is close, is over 6,500. Back then it was at 22. So yeah, those are just crazy, crazy, crazy days. Then you get into the 70s, 73, 74, we had some really bad markets. Sorry, I can't quite get this to move. So 73, 74, the markets fell about 50%. Why? Bad economic numbers, high oil prices, very similar to today. Could we see a 50% drop? Possibly. We have a much better Fed today than we did back then. You don't see the massive days back then, but definitely the markets were negative. So that was a pretty bad market. Then you get to essentially 1987. 1987, you can already guess the probability of that happening. So a 20% day, how often do those happen? Just absolutely impossible. Now that's when they put circuit breakers in place. That's when we had those, that's when people were actually selling put options for senior citizens to add a little income to their portfolio. Those people just got wiped out. Pretty rough year. You had a 20%, a 5%, a 9%, a 3%, an 8%. So now you see a 5%, that's a huge day. And here you're seeing an 8% and a 5%. And it was getting pretty volatile going into it. So it's not like the 20% just happened overnight. It was getting set up. You did have a pretty good recovery for 2 days, but even then you're still well below where you started. So that was a bad year. And then you get into 2000 actually wasn't as bad as it looked because 2000 was mainly tech stocks. If you had small cap or some other value, your portfolio didn't drop all that much. So 2000 doesn't look as bad, but 2008, this is my life. So let's look at Lehman. I can't remember. September 15th. There's the 15th. 4% day. That's a pretty bad day. 4% day, 4% day, 4% day, 3% day. It was getting pretty volatile. The market started at 1400. So at this point, we're down 19%. We got quite a ways to go, but we're down quite a bit. Here, an 8% day, a 5% day, 4% day, 5% day, 7% day, 11% day, 9% day. Look at that week. 3, well, Friday, Monday, Tuesday, 5% days in a row. Some of these 5% days, I remember the markets were so volatile, the market might be up 1% at 2 o'clock. And then all the investment bankers, all the trade desks, they got to balance their books. And you would see the markets just collapse at the end of the day. That's kind of what happened on that day. It was so stressful for me. Everything looks okay, but we had so many of those days where things just collapse at the end of the day. You just get really nervous. And you would see these. I don't have the actual day for that. It would be interesting to see, but it's possible through noon, 1 o'clock, 2 o'clock, everything looks fine, and then suddenly just this massive sell-off at the end of the day. There's a 5, 6, 4, pretty volatile. This is somewhere in here is where I met with Joe. It probably was on a Friday, so it's probably around here where we decided to take our options expired on that Friday. We said, let's go unhedged. We had a debate because the VIX was really high then, really, really high. And so there was some saying, yeah, but if we sell the call options and buy the puts, we'll make a lot of money on the call options. But I was like, no, I just want to take the options off. Still had a really bad day, but the market did pretty well going in the year end. There's that last day, thank goodness, right? I wouldn't have had a positive return without the 30th and 31st, but that saved me. At that point, the market was down, well, %38. How bad was it at one time? I think it was down more than 50%, or right at 50%. So it was down 50% at its worst point. It's a really, really horrible market. And you notice, and here the market's moving a lot. Your boss is like, what do we do? What do we do? And you're trying to assess, is the market telling us something, or is this just massive noise? Are people just trying to figure out? And you're trying to figure all this out. And it doesn't help that your boss is standing there saying, what are we going to do? What are we going to do? You're like, can you please leave my office? But yeah, it's a pretty tough environment. What I did up here, I thought you might find this interesting, is I looked at, if you took 1 billion years, how many days that size would you expect? And I took all the ones I took all of them where you would expect fewer than 100 days in 1 billion years. That's really old because it's 1 billion years times 250 days. So how many market moves? So the smallest one I did was a 7% drop. All right, that's happened 89 times. That's happened 89 times. And then what I did is I did different ones. So here's the tariffs. The tariffs gave us 1 day like that. Where is it? Obviously, April 2025. I probably should change my date. Yeah, I'm going to change the date. That might help give me a few more. No, it didn't change it.
But I think tariffs are different because it was voice allowing.
I think you'll see a few more of the tariff states when you go down to less than 100. So yeah, only one, and it was an update. So we had a 9.5% update during the tariff time after several of them. I can't remember how much. Well, we can go look. So April 2020. I'm sorry, April 2025. That's part of my problem is I'm confusing COVID with the tariffs. So he didn't do it on April 1st. That would have sounded bad. So we had a 4.8% day, a 5.9% day, and then there's that not even 1 in a billion, 9.5% day. So yeah, so the tariffs only gave us one of those extreme days. COVID gave us 5 days. So if you look back at COVID, and you think about the beginning of COVID, it was just like total mayhem. What is going on? So you see some days going into that 4%, 3%, 7%. There's a 9% day followed by a 9% day followed by an 11% day. That's really high volatility, pretty extreme. 6% days. So yeah, COVID was pretty bad. We went out on spring break, right, which probably been around this time, and didn't come back. Pretty horrible. Y'all weren't here during COVID, were you? You were in high school. How does high school go with COVID? How well did your public school teachers do with Zoom? It had to have been a disaster, right? How many high school students were actually paying attention to Zoom during COVID? It had to have been a disaster, but pretty bad. There's a 9% day there, a 6% day. So COVID was pretty bad. The Great Recession, 2008, gave us 6. So COVID and the Great Recession were real similar as far as the volatility. You might think 2008 would have been worse, but COVID is like, is the world coming to an end? We're all going home, not working. What about the Great Depression? What do you think? So you look at Great Recession, you can see some of the largest one up there, 11%, 10%. You notice the biggest days are up days, and that's because if you lose 10%, you got to make more than 10% to get back. So it's kind of set up that way. There's 9% days, 2008, there's a 7% day. But you go to the Great Depression, watch the red show up here. And it's just, there's the Great Depression. Not a good time to be in the stock market. Wow. Pretty amazing, right? You had 34. Now it's a long period of time. It's a decade, but you had 34 days that should not have happened, less than 100 times in a billion years. I also did it by decade. So in the 1920s, there were 5 days like that, but 29 of them happened during the 30s. The 40s, you had 2 of them, probably right at the end, during the early 40s. Then we went 3 decades without any of those massive days. 1980, when do you think those 3 days happened in 1980? All of them in when? October 87, right? You had 6 of them in the 2000 when they happened. All of them in October, November of 2008, right? And you have 6. Did y'all realize COVID was as bad as far as volatility as the Great Recession? It was a pretty horrible time there. So if you look at COVID and look at the bond market, especially treasury yields, it's a pretty shocking what treasury yields did during COVID. There were some massive, massive days for the treasury market that I've never seen before. That just really, really crazy. You may have seen some in the 80s, but that's because When interest rates are at 15%, a 1% move is not that big of a deal. But interest rates are at 1%, a 50 basis point move is pretty massive. So anyway, this is that. Is there any other period of time I should have put in there? You know, I could change the Great Recession to 12/31/1940. Maybe we'd pick up one or two more in there, but you know, you can change the dates. There's probably some others that I could have. You know, you look down at the dates themselves. Do you see anything? Everything I see is those four dates, isn't it? There's 1948. You had a 7% day, but you're just not seeing. There's that 1941. Then you get the .com and the long-term capital management, but those are 6% days. So, you know, most of those big days are in these four events. The overwhelming majority of them are these four events. And you can stop and ask, will we repeat these four events? So the Great Depression, what do people blame that on? A lot of people say it's tariffs. U.S. started cutting back on trade, global trade that caused the recession. We would never do that again. The Great Recession was really bad management of risk, housing, really cheap housing and housing prices coming up. COVID, will we ever have another pandemic? Will the next one be worse? What happens the next time when the government says stay at home and wear a mask? What do you think is going to happen? You think a lot of people are going to say, oh yeah, we'll do that. Could be out civil war, and we're hearing the tariffs. So yeah, I mean, it's who knows? Did we fix everything? Great Depression, so we don't have to worry about that again. Who knows? I don't know if y'all want this spreadsheet or not, but I built it in using Bloomberg. Did you know Bloomberg would go back to 1927 on a daily basis? This is incredible. We talk about productivity. When I was in college in 1985, how long would it have taken me to have done this? It took me less than a minute to do it today. Have you ever thought about that? How much more productive we are today? Where would I have gone? I would have gone to UT Austin Library. I would have gotten massive books like this that would have had all this data printed, but what would I have done with it next? I could go to copy machine and copy all those pages, but then what would I have done? Stick it in a calculator? You think I'm going to do all of this? How long would it take? Can you even guess how long it would take me to do this analysis in 1985? You're talking a couple lifetimes, maybe. I mean, it's insane how this is. Is AI going to be a similar type of change to that? Who knows? It's kind of boggles the mind. All right. All right, so a couple of topics just to finish up on market risk. The pension BGC Corporation, they insure pension plans. So if pension plans go under, they're the ones that come in with taxpayers' dollars and bail them out. And they decided, you know what, stocks make more than bonds. We should greatly increase our stock allocation. All right, now think about this. This is prior to 2008. They said, you know what, we can make more money in the stock market. This is someone that has to insure pension plans. When do pension plans, well, first of all, when do companies that have pension plans go under? During good economic times or bad economic times? Bad economic times. When do pension plans that have high stock allocations, when do they fall apart? During bad economic times when the stock market falls. When is the PBGC going to have its highest call for cash? When the stock market's doing well or when the stock market's doing poorly? When the stock market's doing poorly. They're setting up a perfect storm. So sometimes, oh, there's a perfect storm. Well, if you create the perfect storm, you create it such that when things fall apart, you really, really lose money. You can't really blame it on perfect storm, can you? You set it up, and that's what they did. I don't know who was there at the time. Hopefully one of you will take that job and say, what are y'all thinking about it? I mean, scenario analysis, right? That we're talking about, do the scenario analysis. What's another word for that? Can we stress test this strategy? Does it make sense? What if the 73, 74 stock market happens again? What if the 2000 stock market happens again? How many pension plans went under at that time? What was their allocation to stock? What's that going to do? You know, but people didn't think that. So where do you learn? This is one of my main points in this class. Where do you understand risk? You understand it at the extreme. Think worst case. In fact, find the worst case, which usually people say the worst case is the worst thing we've seen yet. But one thing we know about the worst case, let's say maybe 2008 was the worst case. What do we know about that? In 2007, was that worst case in your analysis? No. So your worst case times 1.1 or something. Find something worse than that, because the next time it's going to be worse. So we're going to talk about this with Doug Hubbard. He talks about what happens at the extremes. What happens at the extremes is this contagion effect. Things don't just get worse, they get much worse because there's these interactions that have never happened before, and they cause things to really shoot out into the tail. And you need to think in those terms. So suddenly uncorrelated things suddenly become highly correlated at those tail extreme events. So you look at 2000 and say, well, it's a housing crisis, big deal. That shouldn't affect the stock market. That shouldn't affect anything else. It's just housing. And then it went through the entire economy. Why? Because investment banks went under, big corporations started going under, people were panicking, you know, the entire thing just came apart. And one thing we talked about before was liquidity, right? When you come to these extremes, suddenly people have to sell. And when you have to sell, that pushes more supply into the market, causes prices to fall, which does what? Causes more people to have to sell. It's that Minsky moment we talked about. So liquidity is a big part of that. Liquidity is not a big issue most of the curve, but when you get into the tails, suddenly it takes markets to extremes. So we're focused more on career risk than we are on our clients' risk. And we've somewhat gotten used to just telling the client, hey, things like this happen. Sorry, nothing we could do about it. But there are things you can do about it if you think through it. But so back to my quote. And this can be Doug Hubbard. Doug Hubbard says, we don't manage the risk we should manage. We manage the risks that are easy to measure because we've got plenty of data. We don't like managing these tough because we don't have a lot of data. They don't happen very often. So we just assume they don't happen. We spend a lot of time managing stuff that's really not all that bad. It's like, wow, I'm really, really good at that 2% loss. Well, it's the 30, 40% loss. And so, you know, this is down to my quote. We spend a lot of time worrying about our cholesterol level where there's a major, major crisis staring at us. And you say, yeah, I can't do anything about that crisis because I don't have any data. It's like, yeah, that's not a good excuse. So, all right, we already talked through that. I want to give you my quote on VAR. So my view on value at risk, all your banks are using value at risk. What does value at risk tell you to do? It says pick a risk tolerance, like 1%, 5%, and assume anything that happens less frequently than that never happens. So you have a risk tolerance of 1%. Hey, let's assume anything that happens less than 1% of the time, let's just assume it never happens. I just showed you things that don't happen 1 in a billion times. And how often do they happen? 35 times in a decade. So, you know, they do happen. I'm retired. I retired at 46. I'm worried about, that's the thing I am worried about. The things that happen less than 1%, I'm more worried about them than the things that happen 99% of the time. So VAR ignores the very risk I'm most worried about. So I'm obsessed with those. We manage investment risk inconsistent with, we manage other people's risk. Or we manage investment risk differently and manage other risk. Almost everybody buys homeowners insurance. And you might ask the question, what's more likely to happen? Your house burning down or the stock market falling 50%? Which do you think is more likely? If you were to look around the country, what's more likely? Your house to burn down or the stock market? How many of y'all worry more about your house burning down than the stock market crashing? A house can burn down, right? But everybody buys homeowners insurance. How many people buy stock insurance with options? Very, very few. Now, I'm not saying you should. What I'm asking is, why do we automatically buy homeowners insurance, but we don't even think about buying stock insurance? Shouldn't we at least think about it? We should think about both, right? Maybe we shouldn't buy homeowners insurance. Maybe it's overpriced, or maybe we should buy stock. Stock insurance is more expensive, but it still may be worth it. So my point is, we don't even talk about it. Why? Because the insurance industry sells homeowners insurance. The stock market doesn't sell stock insurance. Why? Because we don't make money doing that. We make money doing other things. If we made money protecting our clients from stock sell-offs, that's what we would do, but that's not how we make money, so we don't do it. So you shouldn't manage risk based on how the industry makes money, because whose risk are they managing? They're managing their risk, not your risk. So you should manage risk in a holistic way. You shouldn't manage homeowners insurance risk radically different than stock market risk. They're both risk. You have a $500,000 house and $500,000 stock portfolio. You should look at them similarly. And I just told you the really weird thing. So I was helping a guy, he lived out in Medina and there was a flood coming. So I went to his house, helped him move furniture out of his house. He bought a trailer. It was pretty funny because I kept almost running into him because every time he walked in his house, he wiped his feet. And I was like, you're about to be flooded. Why are you wiping your feet? But when we got everything out, and I heard him call USAA, and I knew what he was asking. He was asking about buying flood insurance. And I heard him say, what about 30 minutes? I know exactly what USAA just told him. What did they just say? There's a 30-day wait period. And he says, yeah, what about 30 minutes? And it's like, yeah, you're not going to buy flood insurance when the flood is right out. They're worried about the Medina Dam actually bursting. He did get an inch of water in his house and he lost quite a bit. We did get stuff out of the way. But you're not going to buy flood insurance because the risk is huge. But on the stock market, when the risk is the greatest, this is my opinion, the insurance is the cheapest. When the VIX is low, risk is high. We're way too complacent. That's when you should be buying insurance. So buy it and just hold on to it. Make sure you buy it in a way that you don't wait right up to your expiration, just in case the VIX starts at 10 and at expiration it's at 24. Find good ways to stretch it out. But the stock market, I think, enables you, if you're really paying attention, to manage risk in a very, really intelligent way. I do have a blog for older investors, which is essentially what we just covered there. And in my blog for younger investors is essentially just buy the stock market and don't look at it. If the market sells off, do more. Don't waste your money on houses and cars. That's a big mistake. Put your money in the market. And then don't look at the market. Don't look at what you're doing. It's gonna be really frustrating. I mean, again, you can go 5 years and you have 20,000 bucks. It's like a big deal. Then you hit 100,000, you're like, wow, this is really good. After you hit 100, it starts going pretty fast. And then suddenly you're putting 5,000 in a month and your portfolio is earning 10,000. You're like, wow, my portfolio is doing better than I am. You know, it just takes a while. But if you're watching it all the time, you're kind of wasting your time. The only time you want to watch it is a big sell-off to see if you can stick more money in there and buy cheap, but otherwise just buy stocks. Stock market may not do well. I don't think the US market is horribly overpriced. It's probably a little expensive, but the stock market does horribly next 50 years. Everything else did as well. So it doesn't matter. You can be working to your 80 anyway. So you might as well, you know, be in the stock market. I don't recommend hedging with options and those kind of things for young investors. Just get into the market. If I were, you know, if you read my blog, what I would actually do if I were your age, I'm not giving you advice. I'd probably put 80% of my money into the stock market. I'd probably be a little heavy on value stocks right now. And then the other 20%, I'd start looking for huge ideas that I really love. I like microbes. You might think something on AI side, maybe batteries, maybe robotics, something. Find some new startup company and then find 20 of them and put 1% in each one and just let them ride. It gets that back to if you bought 20 stocks 30 years ago and 19 of them went insolvent and one of them was Microsoft, you would have made a fortune. And so essentially what you're trying to do is try to find that next Microsoft. I'd be really, really picky about it. I wouldn't get those 20 bought too fast. So I might put 100% in the stock market, and I see a really good name, I might take 1% out and put it in one of those names and let it ride and keep that 1% constant. So as my portfolio grows, keep adding to it and let it ride. You couldn't, that 20 stocks and 19 go under and Microsoft's the one. You can't sell Microsoft when you're up 20%. You're waiting for it to be up 400,000% or whatever, something crazy. So Palantir, probably too late. NVIDIA, probably too late, but what's the next one out there? Where can you go to find those kind of ideas? You know, Kathy Woods. Oops. What is the IONG? I don't know what that means, but ARC Capital. She's done horribly here recently. There she is. But she's looking for those next great ideas, and she gives you her whole portfolio right there. Tesla, CRISPR, there's CRISPR, you know, that's, you know, looking at DNA and all that kind of stuff. I don't know, anybody know what Circle Internet Group is? Coinbase, obviously, Shopify, Roku. I don't know how, any of y'all have Roku?
Yeah.
Do you? Does it work?
Yeah.
It's better than Hulu or Netflix or anything?
See, so many times it comes with a TV already. The white TV comes with it.
Yeah, I don't understand enough because I haven't had a TV in like 30 years, but yeah. AMD, they don't have Micron in there. They have Palantir. Yeah, I mean, but she tells you what those ideas are, but essentially you're thinking like she is, because she's trying to find that next huge growth story. A lot of these are really big companies, so it's kind of like, I'm thinking even smaller than that. To me, like with microbes, I think it's a great idea, but I think probably Eli Lilly and Merck and the others are going to capture that, and it's not going to be some startup company. And if they do capture it, they'll get bought out by the others. So I think that's the biggest problem with my strategy is when a small firm does work, the new strategy now is just to buy them out, and that's kind of killing that idea. You don't have too many people that just like, no, I don't want to be bought out by Microsoft $1 billion. I'm going to stick with this. So that's kind of the problem. And I think that's why she's having a tough time finding those great ideas. But you can read that blog. I don't have this in my notes, but I had it somewhere. So I think I must have taken it out of notes. I don't remember. But I was talking to a managed futures manager. I don't see it in here. Let me see if I can find it is foreign. There it is. Where is that? Am I just not seeing it? All right, I put it up here. But I was talking to a managed futures manager. It's a hedge fund. Did really, really well in 2008. Managed futures was like the place to be. We didn't have a managed future. We had macro, global macro, which didn't do well, but managed futures. And he did his whole hedge fund presentation and never mentioned VAR once. I said, wow, this is strange. You almost always get a VAR with a hedge fund. So I just asked him, I'm not saying I like VAR, but I'm just curious why he didn't show VAR. And he told me, and I got his permission to quote him. I don't have his name in there. He was from England, so he had the great accent, so he sounded really smart, so it sounded really good to me. But he said, we don't like VAR. If you want a VAR, I can give it to you. But what he said was before VAR, risk was like this cliff with no fence. And people stood way behind. And then VAR shows up and becomes this fence along the cliff. And now everybody's like, hey, now we got a measurement of risk. So everybody goes up to the fence and leans against it so they can watch over the cliff. What happens when everybody comes up and leans against the same fence? It topples over. And that's what he said is we're now encouraging people to take risks they would not have before. This is what I worry about with BlackRock. BlackRock has this risk model that everybody uses. I thought it was extremely sophisticated, must be some of the best programmers. And one of our alums worked for them. And he told me the projects he was doing on that software. And I said, I would have thought they'd done that 10 years ago. No, they're pretty rudimentary. You know, imagine a model like that everybody's using. Are you sure there's not some flaw that everybody's going to go off the cliff at the same time? It's kind of scary. But he's saying that's what VAR did for us. It gave us this confidence to start doing stuff we weren't doing before. And now we're all doing very similar things. So I definitely see his argument there. All right, so there's price risk. The next big risk we're going to do is credit risk. just to get into it, you got to be real careful. We talked about this with your banks. Banks do define credit risk a little bit differently depending on how they view it. Some view it just as default risk. So credit risk is the risk that someone owes you money and they don't pay you as scheduled. Other people include spread risk in credit risk. So you have a bond, it's paying you, but the firm's much weaker, so its credit spreads gap out and the bond price falls. Some people put that on a credit risk, some people put that on a market risk. So when you look at your bank, they may have spread risk. So all spread risk means is, another way to think about spread risk, you could also call it downgrade risk. They get downgraded by the credit union, I mean, by credit rating agencies. And when they get downgraded, the spreads gap out because they're no longer a triple B bond, they're now a double B bond. So it's downgrade risk, spread risk. You don't have a payment that's missed, but the bond price is going to fall 5, 10, 15, 20%. So you can see how that could be a market risk, but some people put that under credit risk. It's kind of related. Obviously, your credit risk is increased when spreads increase. If you look at spreads, I should have updated this today, but I think I've updated it pretty recently. Through September last year. Now you can do this in Bloomberg. Bloomberg has a ticker for each credit quality. It doesn't tell you much when you look at it. What is LF98TRUU? What is, it doesn't tell you much, but it's the AAA, AA, single A, triple B, and high yield. And so I love this chart. I don't know why I broke it down like that. Let's see if I can find a better one. Somewhere in here, I summarize it for you, but I'm not sure where. Maybe it's here. Let me unhide these columns. Maybe that's the problem. All right, so here we go. So historically, AAA bonds give you 0.29. That's basis points. That's 29 basis points. So if the Treasury is paying 4%, a AAA bond is going to pay you 4.29%. Is that worth it, an extra 0.29%? Probably not going to default. There aren't too many AAAs left, right? Maybe Microsoft and Johnson & Johnson. There just aren't too many. USAA used to be AAA rated. A AA bond gives you 80 basis points over. So instead of 4%, you make 4.8. That's a little more interesting. Highly unlikely to go insolvent. Single A, 118. Triple B, 173 basis points. So instead of 4%, you make 573. That's kind of nice. High yield, almost 5%. Kind of giving you almost a stock return, right? Bonds make 4%, you make 8.8%, but you won't make 8.8%, right? Because you're going to have some defaults. So you have to write off the defaults. There's the average, there's the median. The lowest they've ever been, you saw that back in 97, and the max they've ever been in 2008. So look at this. Triple A's in 2008 were giving you a spread for a triple B bond. Can you imagine you can buy a triple A bond and get the spread of a triple B bond? Anyone want to guess what high yields were doing in 2008? Wasn't 4.8%. Any guesses? 10%, 11%, 12%? No guesses? I was buying a bunch of high yield at the end of 2008. 18% spreads. So if treasuries are paying 4%, they're yielding 22%. You can handle a lot of defaults and still make a lot of money. They did. The stock market was up 70% in 09. High yield bonds were up 70%. And the wonderful thing, if you graph them, the stock market went up like this. High yield went up like this. So you got the 70% return with almost no volatility. It was wonderful. Where are we today? We're at almost all-time lows. You look at triple B, 94 bips. Look at high yield. I don't know who's buying high yield. 267 bips. do you want a 6.767% return when you can get 4% from treasuries? When you know you're gonna have defaults? So yeah, I don't, we really are about the lowest we've ever been on high yield. It's just crazy. Between the VIX and corporate bond spreads, you got a pretty good idea of just, we're talking about a time when the employment report looks terrible. We got a war in Iran. You got tariffs. You got a lot of risky stuff going on, and the bond market saying, no, everything's fine. Everything's good. So I've been buying treasuries. I have not been buying corporate bonds. It's like 12 bips. I'm not going to even notice it. Put $100,000 in, what are you getting, an extra $12 a year? I mean, it's like, give me a break. That's just not worth my time. I'll cut out a couple of McDonald's trips or something. But you can do, if you want to set this up, you can get it. The only issue I'm having is there's something going on between AAA and AA. And I think it might be because there's only 2 AA's left. And I think their spreads don't look correct right now. And I think that's the case. But if you want to set this spreadsheet up, you could certainly do that. One thing they say here is this is not the spread, it's the OAS. So we might talk about that next class. Anybody know what OAS stands for? So go out to Wikipedia, look up OAS, option adjusted spread. All right. It's not the actual spread, it's the option adjusted spread. So you should know what that is. All right, we'll stop it there.